All right, guys, that's all I got from a news perspective. We're now going to transition into our last segment here today. And one thing we've been doing each and every Thursday, Coach Greg, a dear friend of mine, a coach for tackle trading, somebody who's been in the markets for the better part of 20 years. He was a financial advisor. He had the old school type of training first, and then he learned how to trade from coaches and mentors. I know your story very well, Greg. An impressive investor and somebody that you guys want to listen to and learn from. He's got a lot of wisdom in the way that he approaches the markets. And I actually think it's very unique as well, Greg. A lot of people don't have those fundamental backdrops in their training and whatnot. So we've been doing a segment every week called Focus on Fundamentals, where Coach Greg finds one concept that he wants to feature that week and teach it to you guys as Team Tackle. Greg, what do you got for us today?
So the last couple of weeks, we looked at a couple of metrics. We looked at price to earnings ratio and price to sales ratio. So those two ratios are trying to determine value of a company. So really looking at the cost of it and saying, okay, does company A look better than company B just from what I gotta pay to get involved with it? So that's kind of one facet of fundamental analysis that you kind of look at. We're gonna jump into a little different one now. Now what we want to do is we want to start to look inside take it to a car analogy, right? We're at the car show, we're at the dealership, we're looking to buy a car, and we look at the pretty paint on the outside, we look at the sticker price. That's kind of the things we were looking at recently. Now we want to pop the hood and we want to look under the hood. And so this week we're going to talk about return on net tangible assets, or what has been called RONTA, RONTA. Basically, with this particular fundamental metric, we're looking deeper now. We want to see how is this business compared to another business, right? This in and of itself, this number doesn't have as much meaning. You always want to kind of be comparing apples to apples if you can. But what we want to do is we want to see how good are these companies at managing their assets and managing their business, running their business. And this number that we're going to come up with, I'm going to give you guys the formula and all that kind of stuff. This fundamental metric will kind of give you an insight into really, how good is the management in a company. Now, you have to ask yourself, why would that be important? Well, I'll tell you something. There's a guy, his name's Buffett. I think his first name's Warren. One of the things that he talks about most is the management of a company. Not only does he need a product that's recession proof, not only does he need a good business model, but he needs a management structure and a management team that's going to run the business efficiently. If he doesn't have that, I'll tell you, from all the stuff that I've ever learned and read about Warren Buffett, it's a deal breaker, right? And so this is kind of, like I said, this isn't the only metric to find this out, but it's a start. So this is where we're going to go with this. So again, return on net tangible assets. So there's other numbers like return on equity that we'll talk about later. There's all sorts of things. The reason I like return on net tangible assets, here's the reason. A lot of companies have something, when you look at the total assets of a company, right, they have, property and products and inventory and all these kinds of things. And then they throw some stuff in there like goodwill or patents, or there's actually a category that just says other assets, right? And then they don't really break down what those other assets are. The problem with those things are, if push comes to shove and the company had to liquidate, those other assets become virtually nothing. They become speculative, and they're basically thin air. But when you have tangible assets, that's something hold in your hand, you think of it as property or manufacturing facilities or vehicles or things like that. Those are tangible assets that, if, like I said, heaven forbid the company struggles, those are assets that could be liquidated to offset the damage that would happen to shareholders. So with this metric, again, we're starting to look under the hood, and we want to see, can these companies, when the pressure ramps up, when things change from a business environment, or when the economic pressures change, can these companies survive? This is kind of just a metric to look at that. So very simply, to find out our return on net tangible assets, we're going to take our net income, we're going to divide it by our net tangible assets. I'm going to show you exactly where to get those two numbers. We're going to multiply that by 100, and it's going to give us a percentage. Okay, and so what we want to do is we want to look at two comparable companies, which I have a couple today that we're going to look at, and we're going to compare those two companies to see which one from just this one metric, and of course with fundamental analysis, we're building a pyramid right now of fundamental analysis to give us a really good view of a company. There's not, I've never seen it very well done where you just take one thing like a PE ratio and say, okay, well, I've got company A and company B. The PE ratio for company B is better, so I take that one. That typically doesn't work. What we're kind of doing is we're building up a pyramid of metrics that we can look at here. And so this metric in combination with some other ones can give you a good idea of what's under the hood. So, you know, why would we even want to do this? Why would we want to look at return on net tangible assets? Well, like I said, it shows a company and how it's deploying its assets to create profits. And obviously profits are the driver of everything. It's the only reason to buy a share of a company is because you want part of the profit. So that's one of the things. Obviously, the higher the number, the better. The ideal number, the utopian number for a company is over 20%. That is very tough to get. There's not a lot of companies that do that. But there are some companies out there that are really fundamentally strong. So, you know, if you start thinking about, okay, why is this important? Well, when times get tough, like I was saying, and the strain, you know, economically things happen, the strain on earnings, you know, it will cause this number to drop. So the higher the number you start with, the better they can kind of work through these challenges. And again, it comes back to that efficiency of how these companies work. So let's, I'm going to show you a couple of websites that I use here. Actually, it's the same website twice, believe it or not. Just give me 1 minute here. I'm going to get back out of this. So it's yahoo.com. Okay. Now my Yahoo defaults to ca.yahoo.com. That is the Canadian version. If you go to Yahoo Finance, and I'll tell you why I'm doing this in a second. If you go to Yahoo Finance, we're gonna compare Chevron and BP today. Okay. Now, if you go to the Canadian version of Yahoo Finance, what you'll find is when you go into financials, it's going to give us one of our numbers, and it's going to do it very, very neatly. Okay. Net income is one of the numbers that we need. Now, if we go to yahoo.com and go to the non Canadian version of this, let me just get us to there, right there. Of course, it's not going to let me do that because it's a pain. Yahoo.com. Let's just see what I can do to get this up. Mine defaults there. It's really kind of strange. I know it's a Google thing. Bear with me.com/US maybe. There we go. We got her. Okay, so now I'm going to go into finance as well. Now I'm on the US site. And the reason I'm showing you this is because they are different. Okay, I'm going to go in and I'm going to put CVX in there. Okay, Chevron Corporation is what I want to look at. Okay, now if I go to financials, same as the one before, you're going to see a bunch of different categories here. Now, the reason I have both of these up is because, like I said, the formula for this is net income divided by net tangible assets. So net income you can find very quickly on the Canadian site, and you can find net tangible assets very quickly on the American version of Yahoo. And as long as it doesn't mess me up here, where are you? Oh, sorry, got to go to the balance sheet first. I apologize for that. Balance sheet, there you go. Tangible book value right there. That's what we're looking for when we want to determine this number. Okay, so very simply, if we take net income of so this is 3.587 billion. By the way, there's three more zeros that have to go on here. If we divide this number here by this number here, net tangible assets, it's the same as tangible book value. If we divide those two numbers, it comes out to a 2.81% for Chevron. Okay, so 2.81%, 3% doesn't mean anything by itself. But if we take a company that's similar in nature, BP is the one that I'm going to use today. You know, very similar oil company, you know, market caps, you know, up there as well. And we go and we look at this, we can do that same thing and compare the two. So comparing the two, again, I'll go back here, we'll get BP up right here in our quote. So again, we're looking for net income. Net income for them, they made almost 9 billion there, 8.69 billion. So you divide that by the, as I said, the balance sheet here, the net tangible assets, which is 56 billion. And so that number comes out to 15.3%. So the higher the number when you look at return at RONTA, I'm going to just use the short form here. When you look at RONTA, the higher the number, the more efficient they're using capital. So essentially, if you look at it, BP made 9 billion. Chevron only made 3.5 billion. Okay, so then you start looking at the actual net tangible assets. This is with goodwill and all that stuff taken out. This is just hard assets. And you divide those two together, it's going to give you this ratio. And so this ratio can tell us how efficient they are. So in comparing these two, I could say that BP is 5 times more efficient from an asset management standpoint than CBX is. So that's one way to value these companies. Now, again, they're very different. One's a $106 company, one's a $26 company. So this is where you would take some other metrics like price to sales or price to equity and put those together, and you'll start building yourself a really good fundamental picture. So just another little tool in the toolbox here to kind of start to drill down. Okay, what kind of companies do I want to own? Whether it's longer term or maybe a position trade, probably more of an investment. You really want to know these numbers and kind of just compare them. It's going to give you a better decision overall with using the data.